let's dive deeper into this now. We've got Evan Lucas, Chief Market Strategist from InvestSMART, joining us. Evan, pleasure to have you on the program. And what was a horrible day on the market. I guess my question to you is, one print of faster than expected inflation out of the United States. Was this overdone?
Maybe. I think more it's about the recalibration, Ingrid, of understanding that inflation is a persistent and very hard beast to put back in the bottle. The genie is out, and that needs to be sort of put here, is that over the last 2.5 months since the June low to where we're going is the idea that inflation had peaked and that it was showing signs that it was starting to ease in the US. And last night's print, the reason it was such a big one wasn't just the fact that headline was slightly stronger than expected. It's the fact that core inflation was absolutely ahead of expectations at 0.6 of 1%. So it means that the ability to get inflation down, the work that's been done so far had been probably incorrectly priced, and therefore all of that changed last night. So the market now believes that there will be no rate cuts in the US in 2023. 6 weeks ago, they thought there'd be 3 of them. They're also now expecting that by December, that the federal funds rate will be at 4%, not at 3.5%. So all of that was a repricing to happen through the bond market that therefore led to risk off and therefore risk trading US equities. And that is just translated around the world. And unfortunately, for us here in Australia, we weren't spared. It was our worst day since the 16th of May, 2020, where the market fell 3.55% that day. So it is certainly a big, big abnormal trading day today.
Right, and I know futures are slightly higher ahead of US trade, although not nearly enough to make up for the losses. But looking at sort of the twin peak, I guess you say, on impacts of markets, interest rates and inflation, could this sort of create a ceiling for the ASX going forward?
Partly. I think, again, we now need to wait till next, probably Thursday for us here in Australia, and the 5 a.m. release of the US Federal Reserve. There is now belief and probably speculation about what they do and how they do it. So possible if there's a ceiling there. I think the argument also to be made is that we need to be looking at the question of, are we not pricing in the idea that a lower level of growth in the globe is now the more likely scenario rather than sort of the minimal impact we've had over the last couple of years. So that, I think, is what's also missing. So yes, there's a possible ceiling. I think the question more is, where's the floor? Do we test June's lows or do we go further? And that will probably be answered next Thursday.
Yeah, all right. So in this sort of market with the uncertainty ahead, Evan, do you go defensive? What sort of strategy do you take?
This is the $64 million question that everyone's asking at the moment. So it's probably about being as buffeting as you can, looking to stocks or to equity sectors that can look through inflation, that continue to have some form of demand. And they tend to be things like the essentials. So healthcare, education, utilities, those kinds of players tend to do okay during these periods. Certainly not saying they're going to appreciate for you, but they probably won't fall the level that a growth stock or a cyclical stock will. If you look, even at the moment, the really, really interesting part of the market is fixed income, things like bonds, etc. What's sometimes lost in the period that we're going through is that they are now trading at what we call a discount to face value. The Australian government issues bonds at 100 Australian dollars for 2 years, 3 years, 5 years, or what have you. They're trading at the moment around sort of $87 to $92. That gap you will get back at maturity. Plus, you're now getting a yield that is much, much higher. Now, there is risk to that, but that's the other way to look at it, is that if you are trying to buffer yourself from this, you need to go down the asset curve, go towards the most defensive things you can, and understand that even with that, you're still likely to feel some short-term pain, but not as much as a growth equity or some form of growth market.
Evan, appreciate your time on what I'm sure has been a busy day for you. Thank you for joining us.